Thank you for joining our class. Today is the fifth class of ACCA F9 examination. And here is what we would like to share with you today. First of all, we will cover the receivables management. Next, we will cover how about the financing of receivables. Okay, it's also one of the topics under receivables management. Next, we move on to the cash management. And for cash management, we will describe two different treasury models which will be examined in the ACCA F9 examination. And the last topic under working capital management is overtrading. We will share with you how to identify a company is overtraded. Also, what's the solutions or proposals to a company that is under overtrading situation. And we will stop it and then move on to the risk management. We will introduce what is risk management, what's the background of risk management. In ACCA F9 exam, there will be two topics under risk management. The first one is the foreign exchange rate risk. The other one is the interest rate risk. Somehow they are intercorrelated, so we will share with you what's the relationship and also what's the formula or what's the equations put in the formula sheets that will be covered in exam, and we will go through it. And last but not the least, it's about the organization exposures. For example, what's the exposures by an organization in this business model? Okay, so we start now. In receivables management, there will be 5 areas to be involved and covered. First of all, it's about the accessing creditworthiness of customers and credit limits. When you are in a company doing the business with different customers, you have to assess your customers' creditworthiness. For example, how long your customer will pay back to you. Is it any delay payment or is it any credit issue of your customers? So you have to assess the creditworthiness because you have to ensure the receivables will be collected, no bad debts. Okay, it's the job under the receivable management functions. Next is you have to ensure the debts are paid on time and actions on late payment. Debts are paid on time is about the job you have performed in assessing the creditworthiness of your customers and credit limits. And if unfortunately, for example, your customers cannot pay you on time and there is late payment, so what's the actions that you have to take? Okay, you cannot say when your customers have the late payment, for example, 1 week, then you issue the legal letter to warn or to take legal actions against your customers. So we have the procedures or the steps you have to follow in order to ensure that this can be collected and to ensure you can keep the good relationship with your customers. Because sometimes your customer, for example, the accounting department is so busy they cannot handle all the payments at the same time, then there will be late payment, but it's not the intention by the company. So you have to check it to remind them to pay you. Legal actions is the last step to ensure that, for example, your customers are in financial difficulty. So you have to put the last step, take the legal action to ensure your debt can be collected. And the third one about the receivable management is to determine the credit period to be granted. As in the first point here, we mentioned about the credit limit is the money. Okay, and how about the credit period to be granted? Okay, in general, a new customer, he or she has no trade record with you, has no transactions record with you before. So it is completely new customer. For the credit period or for the credit terms that you can grant, it's 0 days. It means this new customer has to pay you on when the goods are delivered to them. So what we call is COD. Cash on delivery. Okay, COD. It means the customer has to pay you once they got the goods, or even a bit advance before they can get the goods. Cash on delivery. Okay. It means there's no credit period can be granted, or even sometimes you have to ask your customer to advance you. The advance payment is required, especially for the some huge capital investment projects. You need to ask your customers to pay you in advance, maybe 50% or 30% of the total invoice amount, in order to ensure the goods are delivered without any with a minimum risk. Okay, with minimum risk, because sometimes if the amount is so big or so huge, then by installment or by advance payment is probable. But definitely, if you are the trading companies trading goods, you can grant a credit period to your customers, given the customers has a good sales history or good payment records in history. In addition, the credit period to be granted, it also depends on the size of the business. For example, if your customer is a very small company and purchase maybe only share with you 0.1% of the total sales, then you may not consider to give any or to grant any credit period to these small customers, because you have to handle all other administration charges and also works. But if for a big company, like for example, you share your total sales about 20 or 30%, then it is worth for the company to grant the credit period to ensure that this big customer will keep buying goods from you. So it is from the business perspective why you need to consider credit period for different companies. And the fourth one is the decision on cash discount to be granted. For cash discount, it means there's no credit period to be granted. Instead, your customers ask you some benefits. For example, the customers can ask you, okay, please give me 30 days on the payment terms. So I will buy the products produced from you. If you cannot do it, then I will go to other suppliers for the same or similar products. So you want to have this business, especially for your sales department. They want this business, so they would negotiate with you. If, for example, there's no credit period to be granted, can any other cash discount to be granted? Given it is a new customer, for example, a new customer, but a big order, okay, with a big order, okay, maybe this big order is about 10% of your total sales. So in general, the new customer has no credit period to be granted. The next is about how about any cash discount? Okay, to be granted because you would like to have this customer, or this customer is a long history with you. Okay, so in general, it's 30 days. But you would like to improve your account receivable period or the account receivable turnover. So you would like to say, give a cash discount to this long history, to this customer with long history with you, so that you can improve this account receivables turnover. Okay, it's also one of the methods to help you improve your working capital needs. Last but not least is about the financing of receivables. So all these 5 receivable management areas we are involved. But for point 1 to 4 here, point 1 to point 4, they are under credit control. So the credit controller, is responsible to manage assessment of your customers' creditworthiness. The credit controllers has to ensure that debts are paid on time, follow up any late payment. Also, the credit controller has to consider how to what's the policy or what's the steps to grant the credit period to different customers. Last but not least is about the decision on cash discount. And the fifth point is about the financing of receivables. It means how to finance of your receivables. Okay, we will cover another topic later on, so that it will be discussed on the working capital needs. But for financing of receivables, there's 4 different types of tools that you can use to finance the receivables. Okay, we will cover it later on. Go to the next topic is the creditworthiness of your customers. What is creditworthiness? It means your customer ability to repay. Your customer's ability to repay. And 2 areas will be assessed. The first one is how much to give credit. The other is how long to give credit. Okay, you have a new customer, or you have a customer with some transactions with you. Then you are the credit controllers. Okay, in the annual review of your customer's credit history, you have to assess in 2 areas. For example, what's in the past, for example, 1 year time. Okay, is it any delay payment? If no, then you have to determine how much the credit to be granted and how long. Okay, say in the past, maybe the company's total sales is 100 million, and this customer contribute 10 million to your company on the sales. And in the past, maybe it is 30 days credit limits. Or credit period, sorry, the credit period is 30 days. And the credit limit, okay, it depends on the ratio. Maybe, for example, you grant credit limit is 0.5 million. Okay, so under this situation, in the past 1 year, 10 million is the annual sales and 30 days is granted as the credit period. Do you consider the credit limit upon 5 million is inadequate enough to cover for the customer to cover? So in this example, for 30 days of the credit period granted and with 10 million sales per year, so in average, assuming full year, the number of days in a year is 360. So it makes the calculation a bit simple. So in this case, the account receivable balance should be on average is about 0.8 million. So you think the credit limit 0.5 million is adequate to support the sales? No, because the customers cannot enjoy the 30 days. Okay, in this case, because when it would like to say put 30 days credit limit, if it would like to utilize this credit days, it means that account receivable balance will be more or will exceed the credit limit you grant, right? So in other words, how much of the credit to be granted and also how long they are related, they are correlated. Okay, you cannot say to consider standalone. For example, only consider how much to be given, and then we still consider the period to be given. So they are related together. So in this case, you have to assess 2 areas. You understand why? Okay, from this simple example, I hope you understand the logic why you need to assess in 2 areas. And for the period, okay, there are short period and long period. The benefits of longer credit period granted is it can help to the sales department because the sales can have a chance to increase. Okay. But also it will have the chance to increase the bad debt. For shorter period, you have to improve the cash flow. But you will kick out some sales opportunity, right? Because your customers may say, "Oh, the terms is not favorable, are not favorable to our company, so we would like to find out other suppliers for the goods." So especially when the people think that your terms is too unfavorable to them in terms of the credit days. And we just mentioned two areas to be assessed. Okay, then we will check what's the documents or what's the methods of assessment. We divide into two types of assessments. The first one is direct assessment. For direct assessment, the salesman reports, customers publish accounts, and direct interview or questionnaires are the examples in under direct assessment category. Here, for example, say the published account is the financial information released from your customers. So it is one of the sources that you can direct assess, or you can directly assess your customers. And also for the salesman reports, okay, we just mentioned the published account. For the salesman report here, you can ask your sales department to check the sales activity, also the payment activity by the customers, to understand your customers' business situation. If in the past year, the salesman report on your customers is saying the sales increased, okay, the sales increased, and also the payment is on time, then you can have one evidence showing your customer is in good financial situation. And also direct interview or questionnaires. You can go to your customer's office and have an interview with them, providing that they agree to do so. And also you can send them questionnaires for them to fill in, and you can base on your questionnaires information to do the assessment. Next is indirect assessment. It means you can go to some third party or the agency third party or agency or agents for the information of relevance to your customers' financial status. For example, the banker's reference, other suppliers' reference or records, or trade reference, or even you can hire an agent or official agent to do the analysis for you. So it is the direct assessment on your customers' creditworthiness. So next topic about the receivable management is the setting credit limits. We consider the 5 C's model. We consider 5 C's model for setting credit limits. The first C is character. It means your customers' willingness to pay. It is quite challenging. It is quite difficult to assess an individual whether his character or her character is willing to pay you or not. Although it is quite difficult, even for a firm. Okay, we can only track the historical record to see whether the company has any attitude, a problem, or issue in paying you the outstanding balance. Okay, it depends on the attitude of the management of your company on the late payment issue. For example, if they are serious of it, they would like to settle it as soon as possible, then okay, fine. Their character is a good guy. But on the opposite, it's when you send them the monthly statement and then to send them the warning letter to collect the debts outstanding, they just ignore you or just put a lot of excuses to delay the payments to you, then you will consider the character is not good. It's not good enough. So it's very subjective. There's no quantitative analysis or assessment in the person's or in an individual character. And the next one is the capacity. For the capacity, it means the ability to pay. The ability to pay. The ability to pay means the company cash flow. The cash flows are sufficient to pay you. Okay. So in this assessment, the capacity of your customers, the ability to pay, you have to assess their financial statement to see their debt level or their gearing level. Okay, first of all, it's about the gearing level, and the most important part is about the cash flow. Is their operating cash flow positive? Okay, it's very important. If their operating cash flow is positive, it means they can get the business itself can generate sufficient cash for the business. Okay, so for the cash flow generated is much more important than the others. Even the company has a very strong asset base, but if there's only the asset very strong but there's no cash can be generated from those assets, it means nothing to you. Next is about in the future. Okay, in the future, because here what we mentioned is about a published account is the historical, right? It's the historical, and also when we call about the gearing, it means the ratio. It also historical. The next is about the future. Okay, for future, you can forecast or project your customers' cash flow for example, in next 6 months, based on some assumptions or some published account information, so that you can project your customers' cash flow in order to assess whether they have the ability to pay in future. Because all the financial management topic we discussed about is based on the historical experience, then you have the projection or the power to forecast in future. Even what we talk about the NPV, okay, the investment appraisal, or the other topics that we share with you before, like the cost of capital, okay, all of these things is based on some historical number or data, and then we can put it to project the future financial performance of your company so that you can manage the financial status of your company. So what we mean financial management is how can you project the future, okay, based on some historical numbers and some published information. So here, ability to pay is divided into two parts. The first part is about the ratios, historical. The other is about the future, the projection. And for the capital level of financial risk, as we share with you, if a company has a high gearing in capacity, okay, we mentioned about gearing, a ratio. Here, we focus on the gearing, okay. If the company finance its asset with a huge asset-based company, what they finance is 99% is financed from the borrowings. So it means the debt, the DE ratio, the gearing is so high, in which some companies are not willing to have any credit granted to those companies because they think these companies have it's risky to them. In case, for example, just if the company has any issue in terms of liquidity, then the company goes into bankrupt, and under the process of liquidation, those secured loan provider will have will be repaid first before any distribution made to the other payables holders. So sometimes, if you can find a company with very high gearing, especially those infrastructure company, very high gearing, and they are difficult to have a good deal or good terms on the payables. And for the condition, it means the level of business risk. Okay, different business have different risk, and different risk means what does it mean to you? It means your collection, or your debt collection will be affected or not. Okay, just an example. If a company is doing like, say, a small business, okay, selling toilet paper, okay, selling toilet paper, and the other one is a big business, build an airport. Okay, so for the first one, selling toilet paper, everyone needs toilet paper. Okay, the demand is very stable, so it means the growth may not be so significant, but it's very stable, and the company can generate very stable cash flow. So the business risk, okay, in this case, maybe for companies selling toilet paper, maybe the level of risk business risk is lower. But for an airport, for example, if a company operate a big project to build an airport, and then to operate the airport, collect the fees from the airport landing and also from the passengers, it depends. It depends on the how many flights or how many people, how many passengers are using the airport, and it is unknown. Okay, if for example it is exceeding the expectation, then okay, it's very good for the company to generate cash flow to repay the debt to the bank loan and also the debt holders, and then it makes some money and also generate cash to repay the payables holders. But if sometimes you overestimate your passengers and number of flights, it means your income is very minimal in this case. But you have incurred a lot of money in building the airport. You borrow a lot of money from your bank, from other debt holders. So the business risk is quite high, especially for travel industry. Sometimes if it is a an virus or an terrorist, then the flight warning issued, a lot of passengers cannot be on board, then it will completely affect your business. So here, the level of business risk, it depends on which industry that you are in. And the last C is collateral. Collateral means what's the asset pledged for the credit granted. Okay, so if a firm established and with long history trading with different customers, then a new customer may be asked to provide some collateral as a pledge to have any credit granted. Sometimes the company asks you to the bank to issue a standby LC, what we call SBLC. So standby LC means a guarantee issue by bank. Okay, and it states that if a company, for example, he or she can ask the bank to issue a bank guarantee, what we call a standby LC, and then the holder of this standby LC, okay, can go to the bank to draw the money if the provider of such standby LC cannot, for example, settle the outstanding balance. So here, standby LC means, for example, company A, okay, and also company B here. And company A is selling goods, to company B. Okay, so B is the customer, and B would like to say have some credit terms with company A. Then company A may ask for the assets to be pledged, like in this case, maybe ask for the standby LC by company B. Company B can go to the bank and the bank issue a standby LC. The standby LC then pass to company A. So company A has the assets pledged against the credit to be granted. Okay, in this case, company A may say, hey, okay, I grant you 30 days of the credit period based on this standby LC. So here is about the collateral. Then, okay, we just cover the 5 C's model under the credit limit setting procedures. Next is how to collect the debts or the account receivables. Here is the procedures or the general procedures of the debt collection. First of all, it's about the statement of accounts. It means on a monthly basis, for example, you issue a statement to your customers showing the outstanding balance and transactions incurred during the month. Okay, just monthly statements. The statement of accounts, okay, in general, is not a request asking for money. Okay, it's just a summary. It's some summary to summarize what the transactions in the past, let's say a month, and also the outstanding balance to be collected. Okay, and after that, the company, your customer should pay you money, and if it's not the case, then you have to issue the polite letters to remind your customer. Say, hey, we are still not the outstanding balance from you still not yet settled. Okay, please help to send back to settle them at your earliest convenience. Okay, it's still polite. Okay, it's still polite. But in case, okay, you're not sure whether they receive the polite letters, so you make a call to them. Okay, because if you only make the phone call to them and you didn't send any letters to them, it is your risk because you don't follow the proper procedures by writing down your request. Okay, so polite letters should be sent first, and then to make a phone call to ensure your customers get the letters. And if your customers cannot pay you after these steps, then you have to ask your salesman to do what they need to do. Is the salesman need to go directly to your customers and collect the debt. Okay, so here, after the salesman going to the door to lock the door and ask for money and no one take care of him, then you can go to the 5th step is to issue a warning letter. Okay, and warning letter is not the same as a legal letter. It has no legal force. Okay, and also your customers you can only mention that your customer has to comply with what two companies agreed to do so. Okay, say the credit terms is 30 days now. Okay, it's more than 100 days. Please, okay, settle down the outstanding balance as soon as possible. Okay, it's about the warning letter. So the tone will be a bit strong, but it's because it's not a legal letter, so it cannot be put put to the courts to ask to let the judge to issue any order to force your customers to pay you. And last, it's about a legal letter. Okay, when all the things above are done, but no reply or no settlement of the outstanding balance, then you can go for the steps number 6, legal letter. So next topic is evaluating cash discount schemes. So how to evaluate cash discount schemes? The decision on how much cash discount to offer depends on the cost and benefits analysis. So in this case, you have to identify what the cost of granting this cash discount, and also what's the benefits from granting discount. If cost is greater than the benefit, is more than the benefit, then you should stop it. But if it is more than the benefit, okay, you can go ahead to pursue your initiatives. So what are the benefits of cash discount? The cash discount may be helping the sales department a lot because it can generate extra sales, savings from lower cost of financing receivables. Because if we will go through the financing of receivables. So here is one topic that you need to consider. The financing cost of receivables is not cheap. The financing cost of receivables is not cheap. So sometimes if you can offer cash discount to your customers and you can generate savings from lower cost of financing receivables, because you may need to go to the some debt collection company help you to get back your money from your customers. And the third benefit is the possible reduction in bad debt, because you speed up the payments to an early payment. So it's chance or it's possible for your company to reduce the bad debt or the outstanding debts. And cost of cash discount is OR, the cost of this cost itself, the cost of discount itself, and also any additional administration cost.